Bringing up the subject of the gold standard is strictly taboo in the economics profession and among financial policy makers. It's long past time, though, to break that taboo. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. Talk about cancel culture. The gold standard, which the U.S. successfully operated under from the time of George Washington to the early 1970s, has for years been the great unmentionable among economists and financial officials, who derisively dismiss it, even a discussion of the topic. Too bad, because the existence of the gold standard would have prevented the economic disasters of this century, including our present woes. You never get inflation with a gold standard. It would have spared us the calamity of the 2008-2009 financial crisis, the subsequent unprecedented suppression of interest rates, and the binge of money printing before and during the pandemic, all of which led to the mess we're in today. Money is a measure of value, just like scales measure weight, clocks measure time, rulers measure space. And we all know instinctively the need for fixed weights and measures in the marketplace. The size of a gallon doesn't change each day, nor does the number of ounces in a pound, or inches in a foot, or the number of minutes in an hour. An economy works best when its currency is a reliable measure of value. For a variety of reasons, gold for thousands of years has kept its intrinsic value better than anything else, better than silver, platinum, palladium, copper, coconut shells, or cryptocurrencies. When you see the price of gold change, it's not its value that is changing, but rather the value of the currency it's being priced in that is fluctuating. Money that is fixed in value makes buying and selling and investing easier, just as fixed weights in the grocery store make it easier to shop. A pint of ice cream today is the same size as it was yesterday. If we return to a gold standard and fix the dollar to the yellow metal at, say, $1,900 an ounce, all it would mean is that if gold went above $1,900, you'd reduce the money supply. If it went below it, you would increase it. Contrary to myth, a gold standard doesn't artificially restrict an economy's money supply. It simply means that the money created has a stable value. Without really intending to do so, the U.S. blew up the post-World War II gold standard in the early 1970s, and we in the world never went back on it. We've suffered for it with an average economic growth rate far below our historic average. Consider this. From the late 1970s, after recovering from the distortions of the Second World War, our average growth rate was around 4.2% until we abandoned the gold standard. Since then, until the pandemic, the average is about 2.7%. If we'd maintained our gold-based average, our median household income would be around $110,000, not today's $70,000. $40,000 more income. So toss out the gold taboo. Let the debate begin. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions, and I look forward to being with you soon again.